Greetings, everyone. Blue Llama here. Without wasting any time, let's talk gold. So, gold's been riding quite the wave since the beginning of 2024. And it seems like this train, instead of stabilizing, is actually getting even more fired up. In fact, a $5,000 per ounce price is actually becoming a very realistic possibility. So, if you're not positioned now, you could very well be watching from the sidelines as prices surge past levels most people only dream about. Obviously, none of this comes in isolation because global tensions have been mounting on multiple fronts for a number of years now. Despite a ceasefire in Gaza, the Middle East still remains heavily uncertain. Similarly, the conflict between Russia and Ukraine also shows no signs of letting up, keeping energy markets and global supply chains at an absolute edge. Now, add to that the recent political turbulence in Venezuela and other flashpoints around the world, such as Iran, and you realize that it's easy to see why investors are seeking safety. Most recently, in fact, Greenland has been on everyone's radar following President Trump's persistence on having the territory officially join the United States for national security. Of course, the president is also threatening massive tariffs against the EU to pressurize them to facilitate this transfer. Now, in times like these, investors naturally turn to gold as a refuge because it's such a great store of value precisely when the world feels unpredictable. And it is exactly this growing demand which is pushing gold higher and higher, making that $5,000 per ounce milestone look less like speculation and more like a very achievable possibility. Now, of course, gold isn't rising solely because of global tensions, because that would make it a purely speculative bet. Its momentum is also being driven by some deep structural macroeconomic forces. For one, central banks have been heavily buying gold lately, and at a pace that represents a sort of fundamental shift in the global monetary system. And you see this with so many countries. Like India has been spending big on gold. China has actually upped its gold reserves on average by about 70 tons every single year for the last 2 decades. Similarly, we have Russia, which has also really doubled down on gold following the sanctions it was slapped with. And it's basically seeking to replace its frozen foreign currency reserves with physical gold custody. So, by doing this, Russia can eliminate counterparty risk entirely. So, these are just a few examples, but they are broadly speaking, there's this real ramp up in terms of how central banks across the globe approach gold. Now, in the past, this would normally happen during widespread recessions or periods of economic crisis. And this time around, for the last few years at least, we see this strong sort of institutional demand for gold, especially as banks are adjusting to currency risk assessments and shifting monetary sovereignty priorities. Now, adding to that, there's also a growing de-dollarization trend unfolding across the globe. And this is a huge underappreciated tailwind for gold because for decades, the US dollar sat at the center of global trade and reserves, but that dominance is now slowly coming under question. Countries are increasingly looking to reduce their reliance on the dollar because it's kind of being seen as a geopolitical liability. Like, for instance, China and Russia are increasingly settling their trade in local currencies rather than in the US dollar. The same pattern is emerging across parts of Asia, the Middle East, and the global south in general. So clearly, there's a broader global trend of countries quietly hedging their exposure to the dollar. So these are just some of the powerful forces quietly working in gold's favor right now. We're all seeing a sort of long term repositioning of capital happening right in front of us. And this is a massive opportunity that most investors still haven't fully internalized yet. So, right now, we're still in that sweet spot where gold is rising, the macro case is strengthening, but many gold stocks are still being priced like this is just another temporary spike. So, there are a few ways of playing this opportunity. Obviously, the first and most direct route to take would be to directly own physical gold itself, because it's obviously the purest exposure you can get. And it does exactly what it's supposed to do. It preserves your purchasing power and acts as a sort of insurance for when the system gets shaky. So, yes, physical gold will definitely protect your wealth. But this video isn't for those who want to protect their wealth. It's for those who want to multiply it. So if you want real upside, if you want to actually capitalize on a gold bull market rather than just sit safely on the sidelines, you need leverage to the gold price. And that leverage comes from gold stocks. Because when gold rises, miners don't just benefit from higher prices. Their revenues increase, their margins expand, and their cash flows sometimes explode. This is especially true for companies with strong assets and disciplined cost structures. In fact, oftentimes, a very modest move in gold can translate into exponential gains in the right stocks. This is especially true during the most explosive phases of a gold market, where high quality mining stocks in the past have shown to outperform physical bullion by a factor of 2x, 3x, or even more. Now, that's how you can multiply the effect of a gold bull run. And this is actually due to something called operational leverage. Now, what that means is mining companies have high fixed costs. This includes labor, fuel, machinery. So when the prices of gold rises, those costs stay flat and almost all the extra price goes straight to the bottom line. So it's very possible that a 20% increase in the price of gold can result in a 100% increase in a company's profits and theoretically double its stock price. So choosing to avoid gold mining stocks could mean leaving the most powerful part of the cycle on the table, because gold stocks are where the acceleration happens. So with that being said, let's get on to our very first stock recommendation of this video. The first stock recommendation is Newmont Corporation. Now, this is one of the largest gold producers in the world. It has a market cap of $130 billion and it's based in Colorado. So there's a bunch of things to love about this company. First of all, while it is primarily a gold player, it also has a sizable silver and copper exposure, both of which, just like gold, are also experiencing strong long-term demand fundamentals. Now, this of course helps diversify its revenue streams and reduce dependence on a single commodity cycle. Now, that means when gold prices do temporarily dip, Newmont still has other sources of cash flow to lean on, which is a big advantage compared to pure play gold miners. Secondly, the company has an extremely strong balance sheet. And obviously, having a strong balance sheet is very important when you're investing in a mining stock. So, Newmont recently brought their net debt down to nearly zero while maintaining a $5.6 billion cash reserve. Now, their credit rating was also upgraded to an A3 grade. So, their financial position is quite strong. And this is exactly the type of company you want to bet on when there's a gold climb like this. Now, also, the company's strong balance sheet strength, it actually gives it the flexibility to truly return value to its shareholders. In the past 2 years alone, Newmont has returned about $5.7 billion to its shareholders through buybacks and dividends. And the management has actually said that they prefer returning value to their shareholders than to even acquire new projects. Now, this is great because it may sound like you're pandering to your shareholders, but this is very strategic. It prevents value destruction at cycle peaks. Now, thirdly, and this is not very common by the way, but Newmont is also actively engaged in optimizing its portfolio by actually shrinking, and very strategically at that. It recently sold non-core assets and streamlined its equity holdings and generated over $3.5 billion in after-tax cash proceeds in 2025 alone. Now, obviously, the goal here wasn't just to raise cash. It was more about focusing on the highest quality and most profitable assets. Now, as you can see, both its revenue and its earnings have been in a strong climb mode lately, and it actually seems like this momentum has just gotten started. Remarkably, the stock is trading at around 18.9 times its trailing earnings, which is cheap considering that the median PE ratio in this sector is actually close to 25x. Now, similarly, its EBITDA is expected to climb by a staggering 58% over the next 12 months, owing to its strong operational leverage. Also, its disciplined cost management and the ramp up of low cost production from new mines like the Ahafo North. At the same time, the median EBITDA growth expectation of this sector is only around 5%. So that's a massive disparity, despite the stock trading much cheaper than its peers, given the earnings it does have. So overall, Newmont is well positioned to deliver sustainable long-term value, even if things were to turn volatile in the commodity markets. So that was our first pick. Next up, we'll be looking at a company called Goldfields Limited. This is a $46 billion South African gold producer with a diverse portfolio of mining operations across several continents. Now, this is the type of investment that typically appeals to investors seeking stability with predictable cash flows and very little risk. The management has a real long-term vision that goes beyond the typical quarterly earnings cycle. They explicitly plan in 3 horizons. There's a near-term 5-year plan, a medium-term strategy to extend and optimize assets, and a long-term vision that looks decades into the future. In fact, the company actually invests heavily in the assets it already owns to make them productive for much longer than their current life estimates. For example, in its Granny Smith project, they're adding a new material handling system which extends the mine's operational life by almost 6 years, while also lowering costs per ounce. Similarly, in its other sites, such as St. Ives, it's also taken a discretionary investment approach, which is focused on life extension, efficiency upgrades, and cost reductions. So instead of constantly buying new mines and chasing short-term production, the company optimizes what it already has, unlocking additional value that can compound over decades. Now, moreover, Goldfield is also really going in on its exploration activities, with over 20 active exploration targets spread across its portfolio and in partnership-led initiatives. And this is not exploration for the sake of replacing depleted ounces, but a deliberate strategy to embed long-dated growth optionality inside the existing asset base. It's also prioritizing brownfield and near mine exploration where infrastructure, permitting, processing capacity, and operating teams already exist. Now, this dramatically lowers the hurdle rate for any discovery. A new ounce found near an existing operation is not valued the same as an ounce found in the middle of nowhere. It's faster to monetize, cheaper to develop, and far more likely to convert into cash flow per share rather than just headline resources. And if you look at the company's top and bottom line climbs over the last several years, you actually see consistent and sustained claims. And remarkably, a big chunk of this is internally generated growth because of management's focus on asset optimization and debottlenecking. Also, let me just add, take a look at these cash flows. Apart from a brief dip in 2023, Goldfields has consistently been raising the bar since 2018 when its operating cash flow amounted to $568 million, up to nearly $3 billion now. So this is a fast climbing cash printing machine. I must add that Goldfield has seen its long-term debt climb to about $2.1 billion, which is the highest it's ever been. But this doesn't exactly seem beyond control when you zoom out and look at how the debt is actually being used and what it's buying the company. Plus, like I said, this is a company that's generated $3 billion in just 12 months. So bringing this debt total down seems no challenge at all. The stock also seems nicely valued, trading at 25 times its earnings, which is pretty much the standard in the sector. But I actually think that's cheap for this company because it's expected to see its EBITDA jump by 54% in the next 12 months compared to the sector median growth expectation of only 5%. So I think it offers a lot of value in its current price, and this chart seems very likely to keep its strong momentum going, especially with the strength seen in gold prices. Okay, and now finally for our last pick, we'll be going with Orla Mining, a $6 billion mining company based in Canada. And like the other companies we've discussed, while it does deal in metals like copper, zinc, and silver, its primary moneymaker is, of course, its gold mines. So Orla is pretty much set up like a compounding machine. And what it does best is identify underperforming and underappreciated assets, then systematically unlocks value over time. At its Musselwhite project, for example, they didn't just acquire a producing mine. They acquired an underutilized mill, a long and continuous ore body that hadn't been fully tested at depth, and also a workforce and infrastructure that severely needed capital and attention. Since closing the deal, Orla has actually upgraded its underground equipment, improved ventilation systems, and most importantly, pushed decision making closer to the mine face. And it's actually launched one of the most aggressive exploration programs the asset has ever seen, and pretty much doubled its output at the site since the acquisition. The result is a much higher throughput, improving grades, and early drill results that suggest the mine can run far longer and far harder than the market previously assumed. This strategy is far more rewarding than starting a mine from scratch because starting from scratch carries all the upfront risk, such as permitting, construction, unknown geology, workforce setup, and capital intensity, while Orla's approach leverages already existing infrastructure and proven operations. So, by acquiring or partnering with producing or near production assets, Orla can skip the early stage capital burn and avoid years of negative cash flow. It can also deploy that cash into value accretive improvements like increasing throughput, adding high grade stopes, and extending mine life. Now, if you look at its numbers since it started earning a revenue, you can clearly see that there's been an undeniable climb, which is especially visible in its gross profit. From $2.7 million just 5 years ago to $500 million now. What basically happened is that as production stabilized, costs came down, fixed infrastructure started working harder, and every incremental ounce began dropping more meaningfully to the bottom line. And that's exactly the sort of companies we look for when we are facing such a strong gold trend. Speaking of its bottom line, this figure is expected to climb quite rapidly in the coming years. In 2024, the company brought in an EPS of 33 cents, which is expected to balloon to 89 cents for 2025 and $1.40 for 2026, as per analyst consensus estimates. So for a company that will most likely more than quadruple its earnings in just 48 months, you might expect a heavy premium in price. Well, as it turns out, the market still seems to be pricing Orla as a steady-state operator instead of the high-growth engine it already is. Its EV/EBITDA ratio of only 14 is only slightly higher than the median ratio in the sector of 12, even though the company's growth expectations massively outpace the overwhelming majority of its peers. And that's why this setup is so compelling. The upside doesn't really rely on gold prices going parabolic or on perfect execution across every front. It relies on the market gradually recognizing what it already is happening with the company operationally. So these were my top picks for this gold cycle. Now, what makes this opportunity especially compelling is that these companies don't require a perfect world to perform. They're already executing well at today's gold prices. So if the gold prices simply stay as they are, these companies generate strong cash flows. And if gold continues moving higher, which the macro backdrop strongly suggests, then the upside actually becomes exponential. So right now, we're still early, capital is still rotating, and valuations are still lagging reality as we've seen. And the window to build positions calmly, rationally, and at reasonable prices is still briefly open. But obviously, it won't stay that way forever. If gold is heading where the macro forces suggest it is, and these are the kinds of stocks you'll wish you had taken seriously sooner. Now, that was it from me in this video. For those who are interested in spotting these opportunities for themselves, well, I've shared my full framework for picking the right mining stocks on my Substack. The link is in the description. If you found this breakdown helpful, please consider subscribing. It genuinely helps the channel grow and lets me know that this kind of deep, long-form analysis is something you want more of. Insights like these are usually locked behind expensive paywalls, and the support really does make a difference in whether I can keep putting this content out consistently. Also, feel free to drop a comment below and let me know what you're currently invested in or how you're playing the gold theme right now. I read every single comment. I'll try to respond to them as well. And finally, tell me what you want the next video to be about. Another gold stock perhaps, a different commodity, or a completely different macro setup altogether. This was the Blue Llama. Thank you for watching, and I'll see you on the next one.